in addition to all the different approaches to acquire a property, plant, and equipment through cash purchase, deferred payments, debt, equity, exchange, the company can also self-construct its assets. The value of self-construct assets is similar to the value of the product. Basically, it's the direct material plus direct labor and the manufacturing overhead. Remember, that's the three elements of manufacturing cost or product cost. We borrow the methods to determine the product cost in the valuation of self-construct assets. So if we have these three elements, we can document the value of this property, plant, equipment. But identify the cost is not easy because there's no external transaction to establish an exchange price. So there are two critical issues arise. One is what's amount of indirect manufacturing cost to be allocated to the construction. And because direct material, direct labor, they're all traceable, so this no problem. Similar to the we have learned in the managerial accounting, we basically assign the manufacturing overhead to each product to determine the product cost. But in this chapter, we will not talk about this issue. We are talking about the interest cost. Why we should include interest cost at the value of the assets? Because usually the self-construct assets needs a large investment. It needs a large amount of money, and these money are assumed from borrowed fund, or even the company use its own fund, but there's opportunity cost, interest. For the self-construct assets, we need to capitalize the interest cost to the value of the self-construct assets. As I said, in this chapter, we are not focusing on the overhead cost allocation. We focus on the interest capitalization to determine the amount of interest to be capitalized as part of assets, the self-construct assets. To capitalize interest, we need first identify the qualifying assets. Basically, the assets are constructed by the company for its own use, as well as discrete project for sale or lease. And only interest incurred during the construction period is eligible for capitalization. So interest is the cost of using money, which is related to the time. So the construction periods will determine the amount of interest to be capitalized. The next is how we determine the period of capitalization. It starts when the construction begins, ends when the construction is ready. So this is a construction period. Also, it is a period of capitalization. We also need to calculate the weighted average accumulated expenditure. This company decide to construct a building themselves starting on January 1st, 2024. So this is when the project or construction starts, or when the interest should be capitalized. The building will be complete next year, June 30th, 2025. We are just using the example, how much interest to be capitalized from January 1st, 2024, the first day when the construction of this building starts, to the end of this fiscal year, 2024. We will decide how much interest in this year to be capitalized as the value of these assets. And during 2024, there are 3 capital expenditures occurred on different date. This is the amount. Total amount 1.5 million. Expenditure was just on the first day. Next one was on March 31st. Then September 30th. There are also a couple of expenditure in 2025. As I said, we just need to calculate interest capitalization for 2024. So for this year, we don't consider these two expenditure. And the company has three debts. One is debt borrowed for these assets, $1 million. There are also two other general debt, $2 million, $4 million. The interest for each debt is 6 and 12%. And this debt outstanding during the entire construction period. If the capital expenditure is less than the 1 million, so we will assume all the expenditures using the fund from this loan. So we are only using the 8% to calculate the interest expense. If the capital expenditure is greater than 1 million, we will assume the interest come from these two debts. These two debts are general debt. First step is determine the weighted average accumulate expenditure. We know the total expenditure was 1.5 million. If this 1.5 million were evenly incurred during the year, weighted average accumulated expenditure is very simple. We just use the total 1.5 million and divided by 2. So that's weighted average accumulated expenditure. But since we are given the timing of each capital expenditure, to determine the interest, we need to use the time the fund incurred interest. These are three capital expenditures. The first expenditure was on the first day in 2024 to December 31st, 2024. That is 12 months. So portion of year outstanding is 12 over 12. This 12 is the number of months in 1 year. This 12 represents the portion of the year, this expenditure outstanding. The next one was on March 31st, 2024. The portion of the year outstanding was 9 months. From March 31st to December 31st, 9 months. This 12 is the number of months in 1 year. September 30 to December 31st, 3 months. Okay, so we multiply the portion of the year outstanding to the actual expenditures. Then we convert to time-weighted expenditure. So the total expenditure will be 950, not 1.5 million. The reason is these expenditures were not occurred at the beginning of this year. So if all these expenditures all occurred at the beginning of 2024, January 1st, the time-weighted expenditure will be 1.5 million. However, this expenditure occurred at different time point of the year. Finally, we use this as a principle to calculate the interest. Since 950,000, which is less than the 1 million, this specific debt. So we assume 950,000 all from this debt. So we only use 80% to determine the interest. So we use 950,000 multiply 80%, so interest 76,000. Finally, the total cost of these self-construct assets is sum of the expenses and the interest. So total book value of these self-construct assets to be documented by the end of 2024 should be 1,576,000. In general, this interest we calculate, it has another name called avoidable interest. That means if the company do not self-construct these assets, this interest can be avoided. Then we compare the actual interest. Basically, we just multiply the principal of each debt with their corresponding annual interest rate. the total interest expense incurred by this company in 2025 was 680,000. Only 76 will be capitalized as the assets. So the book value of these contract assets in the next year we will follow in the similar procedure from step 1 to step 3. And we're going to calculate the weighted average accumulated expenditure. But since the project will be complete by the middle of 2025, so you should calculate the portion of the year outstanding from January 31st, 2025 to June 30th, 2025. January 31st to June 31st, that's 5 months. April 30th to June 30th, that's 2 months. You multiply each expenditure. Since the $1 million fund was used 950,000, so there's only $50,000 available from the first debt. You may ask why I use June 30th, 2025 to count the portion of the time debt outstanding instead of December 31st, 2025. The reason is the construction was expected ends on this date. In other words, the second half of the year, there's no more interest incurred from this construction. So we use this portion of year to calculate the expenditure. So the first one is 250,000. The second one is $50,000. So the total weighted average accumulated expenditure in 2025, $300,000. The $300,000 weighted average capital expenditure, where the fund from? Remember, the specific debt was $1 million. In 2024, 950 was used, so there's only $50,000 left. So actually, for the 300,000, 50 from the specific debt, the interest rate is 8%. The other 250 are from the general debt. The debt of these two. Since there are two different interest rates, so which interest we use? Yeah, basically, we need to calculate weighted average interest rate. How to determine the weighted average interest rate? Just use the annual interest of each debt divided by the sum of the principal. So the first general debt, 120,000, plus the annual interest of the second debt divided by the total principal, $2 million plus $4 million. So this is 600,000 divided by 6 million. So the average of interest from these two general debt, 10%. So actually the interest rate is between 6 and 12%. Then we are going to apply the 10%. Based on the source of fund and the interest, we can calculate the total avoidable interest cost. 4,000 for this one, 25,000 for this one. So total 29,000. So in the second year, the company is going to capitalize another 29,000 interest to the value of the asset. In 2025, the total expenditure incurred was 900,000. Therefore, the book value of these assets, incremental book value, will be 900,000. That's 2 capital expenditure plus 29,000. So it's 929,000. So that's the incremental cost in 2025. Remember, we have determined the cost incurred during 2024. The sum of both will be the total book value of this self-construct property, plant, and equipment. We are given the 4 capital expenditures, and then we calculate weighted average accumulated expenditure. The amount of capital expenditure multiply the portion of year outstanding. The first one was 12. The second one was 9 months, 4 million. The third one was 6 months, from June 30th to December 31st. Last one, October 31st to December 31st, that's 2 months. So that's portion of the year outstanding. Multiply each capital expenditure, we have the weighted average accumulated expenditure. The company has 2 debt. One is $4 million, 10% for this construction at the beginning of the year. So 7.5 million, 4 million is from the first debt, interest 10%. Then the rest 3.5 million are from this general debt, 8%. So answer is 680,000.